today's print showed an acceleration in all the areas that the Fed does not want to see. And so I think the Fed is looking prescient here, that it has not declared victory, that it is not yet convinced that the deceleration trend in inflation will be durable. And so that means that they are fully justified on staying on hold for longer.
But for how long will inflation remain public enemy number one, Ellen?
So, look, I think there are two issues here, right? So inflation needs to decelerate further, and we do expect that, but we've been highlighting that sticky services inflation would mean a re-acceleration in the first quarter, and that has underpinned our view, which we've had for quite some time, that the Fed would not cut rates until the middle of the year. And so we are seeing that re-acceleration in inflation that we expected. The issue now is it just a one quarter re-acceleration as we expect, or is it something more lasting? Because still these inflation numbers surprised us to the upside. But the other issue is that the deceleration in inflation has to come alongside slower growth. And you ended up with fourth quarter GDP being stronger than expected. Holiday sales looked stronger than expected. And so all eyes are on the retail sales report later this week, where we expect an actual decline in retail sales. That's going to be very important in establishing the backdrop of slower growth, which would lead the Fed and market participants to assume that perhaps this acceleration in inflation truly is just temporary.
Ellen, that's a great point, and I wanted you to expand on that, and I wanted to ask you if the labour market and the US consumer are at a tipping point or nearing an inflection point that is consistent with what you just talked about and the slowdown in the broader economy because of the tightening cycle.
Yeah, so I wouldn't call it a tipping point. What I would say is that we do a lot of work here where we do deep dive into segments of household experience. And you have low-income households that have already gone through their recession. It was when excess savings ran out. They were still trying to battle high rates of inflation that were disproportionately burdening to them from food prices, rental prices, energy prices. And wage growth has continued as inflation has come down. And so they're finally feeling a bit better in terms of real wages are growing. But they have been pulling back on spending, and that has continued. And so you have this segment of the population where they did get to that tipping point last year, and we saw them roll over that tipping point. I think the bulk of consumer spending in the U.S., though, is done by the wealthier households, and that's where we have not seen a slowdown in spending, in particular, spending on services, luxury services, experiences. It's an almost insatiable appetite. And so even in our consumer surveys, the wealthy have given no indication that they're going to pull back on spending as yet. And to give you a sense of how important that group is, the top 20% of households, so the top income quintile, is more than 40% of all consumer spending. You put the top two income quintiles together, it's more than 60% of all consumer spending. So you're not going to get this sort of cliff effect in consumer spending until you get the wealthy to slow down or stop spending abruptly. And the only thing that leads to that is white-collar layoffs. And that's what we're not seeing. We're not seeing broad-based white-collar layoffs. And so that would really be your key to the consumer spending outlook in the U.S.